Hi, thanks so much for joining in to this earnings conversation on BQ Prime. I'm speaking to the management of JK Tyre and Industry. We've got Sanjeev Aggarwal, the Chief Financial Officer of the company, joining in. Sanjeev, thanks so much for taking the time and break down the numbers for us. It looks like a pretty picture, at least from our end, and I'm pretty sure that you will agree with us.
Yes, thank
Is
you.
it
Thank you so
primarily
much.
the input costs that have been a big benefit this time around and significant improvement in the EBITDA margins that is very visible?
Thank you so much, Lex, and thanks for having me on your show. So you are right. We have recorded excellent numbers this quarter in Q2 of FY24. And the sales has been consistently growing. The profitability has grown multifold times. And this is all a result of multiple factors. In fact, we have also been, earlier as we explained, we have been improving upon our product mix and premiumizing it actually. So the premium product mix, better product mix with new products, innovative products, which we have launched over the period in last couple of quarters. So that has also contributed majorly apart from supporting us in terms of the stable raw material scenario. So raw material has also helped us, and the EBITDA margins have gone up as compared to the corresponding quarter by about 718 basis points. So which is quite significant. So we are quite happy, and this is for the highest ever quarterly profit.
Fantastic. Sanjeev, could you break that down for us? When you say that the volume mix has improved, truck radials in any case are a significant chunk of the volumes as I understand it. But what specifically are you referring to? If you compare the year ago quarter, can you see a visible change in the mix?
So as I said, Alex, actually the new products which we have launched, like the fuel efficient tires or high performance tires, the innovative products such as the smart tires and the EV tires, the whole bouquet of the EV tires which we have launched. So these are all picking up traction, and because of all this, there is a very healthy improvement in the product mix. So that has contributed a lot.
Okay. Could you give us the breakdown of, and normally I see this in your investor presentation, I haven't had a chance yet, but what is the breakdown in terms of the contribution from OEM versus the aftermarket?
So the revenue, broadly, I would tell you about 55% is coming in from the replacement market, and approximately 30% is from the OEM segment, and the balance is from exports.
Is this a significant deviation? If I remember correctly, your replacement is significantly high or has been significantly higher at around 80%, right? If I'm not mistaken, Sanjeev, why is there such a big deviation?
No, there is no deviation as such. This is
Okay.
replacement market has been like this, and the OEM over the last couple of quarters, since the time there is a pickup from the OEM side, and because of the availability of semiconductors and chips, so there is a good growth from the OEM side also.
Okay, so 50% is, or rather 30% is the normal rate.
Yes, in the present scenario, it came down when the OEMs were not actually were not able to manufacture the products because of the non-availability of semiconductors. But that is history. Probably now more or less they have been getting what they want.
Understood. There is also a significant development, Sanjeev, with regard to the expansion of capacity. Could you tell me about how this capacity will be expanded? I believe just over 1,000 crore will be invested, and but it's a very quick increase in capacity. Could you tell me about this?
So you are right. We have already been implementing about 1,100 crore rupees of capex plan. And out of that, partial implementation has already been done both in the PCR and TBR segments. And further, we are considering some expansions, particularly in PCR, to increase capacities further. Because we believe that there is a very good demand out in the market, not only for the TBR, but also for the PCR. So we are trying to actually catch up that growth. And hopefully we will be able to implement our projects quicker.
Okay, approval is there for 500 crores of QIP. Is this for that purpose?
So definitely there will be multiple kind of the utilization apart from the capacity. expansion, definitely we will be utilizing partially for general corporate purposes and also for various other requirements of the company.
The reason I ask is I'm trying to understand how this is being funded. And this is a part of more CapEx, or is this the primary expansion that you are undertaking right now?
No, so this is definitely the expansions will be partly funded through the internal accruals and the equity which we are planning to raise, as we have informed the stock exchanges also today. So, and the balance will come from the debt side, which is normally the case always, right? So we are lining up to raise about 500 crore rupees. So if broadly the capex, which is going to be about 1,000 crore rupees, so out of that, if we are going to fund in the ratio of, let's say, 1:1, the equity is going to come from the market, fresh equity, and then internal accruals also will be there, and some amount of loan. So we are very, very cautious about the leverage, and we have been able to successfully deleverage the company in a big way in the last couple of years, as you would have noticed. And
I'm coming to that, but could you specifically for this project, approximately how much debt would you think that you would have to raise?
So that we are deciding as of now. The focus is entirely on, let's say, funding the projects, expansion projects, through a mix of debt and equity. So that we will decide at some point in time in future.
But it won't be a significant increase in debt, you're saying?
No, of course. As I was explaining earlier,
Yes,
we have been actually focusing on the deleveraging, and at the same time, because we have to grow and we have to increase our capacities across segments, product segments, so we have to take up expansions, but very prudently, which we have been doing actually. And these projects expansions will be funded through a mix of both. That
understood. So that number, Sanjeev, at the end of the second quarter, where does the debt level stand at? Net debt?
Today, let me tell you very frankly that today the debt levels have been about 4,000 crore rupees overall for the company as a whole on a consolidated basis. And out of that, the long-term debt which are which are taken for funding the capex expansions, right? So that is approximately 2,000 crore rupees, let's say, to 50% of that, and the rest is the working capital, very broadly, right? So this is going to improve further, and the ratios, just to give you an idea how it has improved over the last 1 year particularly, that we have brought down the debt to EBITDA from 3.39x to almost about 2.25x now. So which is very healthy and very comfortable. And going forward, our endeavor will be to remain within the corridor of debt to EBITDA of about 1.5 to 2.
Okay, so that there is going to be, and over what period do you think that you will achieve this, Sanjeev?
So in the next about 2 to 2.5 years time, I think we should be able to achieve this.
But that's also a factor of an increasing in the EBITDA as well, right?
Yeah, so that is a factor, and because we see that the raw material price scenario is going to remain stable more or less, there's no likelihood of any, let's say, the significant movement which we have seen in the past, unprecedented increase in raw material prices. So if that doesn't happen, and if it doesn't become a spoil, then I think the growth story is very good.
Okay, let's talk about that, because the festive season is upon us, and I think generally we're expected to be sanguine on demand, particularly for four-wheelers. It's looking decent,
Right.
and in two-wheeler space as well. Sanjeev, we're talking about premiumization, but in the commercial vehicle space, which is primary product for your or category for you, how is the demand looking there? And do you again? I'll go back to my earlier question. That 30% OEM demand seems to have done wonders for your profitability and for your margins as well, and the mix is looking very pretty. Does that continue to be the case in the rest of the year?
Yes, I believe so. And going forward, and because first the festive season, which is going to give a very good boost to the demand further, particularly in the passenger car segment, and the four-wheeler, like the commercial vehicle segment also. Just to give you an idea, the freight is increasing, and the growth rate which is expected on the freight increase freight, I mean the weight which they have to carry, the trucks have to carry. So that is increasing at the rate of about 7 to 9%. So that is a very healthy sign for the demand in the auto sector, particularly in CV and passenger car segments. So we see in the near to medium term, particularly, a very good healthy demand growth, and that will boost the demand for the tires as well.
Okay, I saw in the update that you're at capacity utilization of above 90%. Is that correct?
Yeah, we have been operating at about 90% level, and that is a very good sign again. And that is why we have been considering the expansion of our capacities.
But then from that perspective, if you're so close to capacity, would you be keeping a higher amount of inventory? Are you operating with slightly higher inventory?
No, we have in fact been able to manage inventory levels and the receivables levels at a very good level, so that there is no unnecessary blockage of funds in the working capital. And we have been able to cater to the market's demand in a very good manner. So there's no higher level of inventories which we have been carrying.
You don't anticipate that you won't be able to cater to demand, at least for the short term?
No, because we have been having large capacities for all the product segments. So we will not be falling short of anything which is in demand for us.
Okay, leave us with an expectation, at least for the rest of the financial year, Sanjeev. All things ceteris paribus, as they say, and it's very difficult to say that right now, but assuming that does take place, 15% margins as a going rate, is that achievable? Do you think that this is the standard rate going forward?
A very good question. In fact, this is something which we ponder upon every day, that is it really sustainable at this level? I would say yes, because we have done a lot in terms of improvements across segments, in terms of the new products, innovative products, premiumization of products, efficiency improvement, volumes improvement. So all across we have been working on, unless this is disturbed by the increase in raw material prices, which, as I said earlier, it's very unlikely, except for the fact that there could be certain spikes here and there. But I think in the long term, we are expecting the price scenario to remain stable.
Okay, final question. Fundraising, when do you expect it to close by?
So we have been regularly, constantly working on it, and I think for the expansion projects in next 6 months, we will be fully tied.
Fantastic. Thank you so much, Sanjeev, for speaking to BQ Prime, and look forward to the next chat. All the best.
Thank you so much. Thank you very much. Thank you.